In this module, we are going to look at cost behavior. Now, it's very important for managers to understand the costs that they are managing. Some costs will change as activity changes, some costs will not. Once we understand cost behavior, we're going to introduce then a most powerful management accounting technique, and that is the contribution margin. The contribution margin assists managers in planning and making decisions. But to begin with, we must distinguish between what a variable and a fixed costs are. Now, cost behavior, of course, is the study of specific cost changes with changes in the level of a business activity. Some costs will change, some will not. As I said, this helps management plan operations and make decisions with regards to different or alternative courses of action. I'm going to use a manufacturer, but we're going to be talking here about all types of businesses and entities. And the first thing to focus on is activity. Now, activity can be defined in many ways, but basically it's going to be either sales or production, but it could be miles driven, room occupancy for a hotel, even dance classes. We're going to look at how costs behave and changes in the level of business activity. We must define that activity. So the activity level is also called the volume level. Now, a variable cost is a cost that will vary, pay attention, in total, in direct proportion to changes in the level of activity. So it's in total and in direct proportion. Direct proportion means that if the activity level goes up by 10%, the total variable cost will go up by 10%. If the activity level decreases by 25%, then the total variable cost will decrease by 25%. Now, let's take as an example, I'm going to manufacture a desk, a simple, straightforward desk. And I look at the cost that is involved in manufacturing desks. Of course, one cost is wood. And I analyze it and I determine that the wood costs $50 for each desk I make. Well, if I make one desk, the total cost will be $50. If I make two, it'll be $100. If I make 10, it'll be $500. So you see, as activity doubled, the cost doubled. If the activity went up tenfold, the cost in total went up tenfold. However, the thing about a variable cost is that it changes in total, but it remains the same on a per unit basis. If I make one desk, the per unit cost is $50. If I make two desks, the per unit cost is $50. Make 10 desks, my per unit cost is $50. So the variable cost will remain the same per unit, but the definition of a variable cost is that it will change in total in direct proportion to the level of activity, to changes in the level of activity. So here's an example. This company manufactures computers, and it contains a $10 camera. So therefore, if I produce 20 or 2,000 computers, then the cost of my camera would be $20,000 total cost. It's a variable cost. If I was to graph it, at zero production, zero total cost. But as production increases, the costs increase proportionally. However, on a per unit basis, it remains the fixed. So if I was to graph variable cost on a total variable cost, it changes proportionally in total with changes in the level of activity. On a unit basis, it remains the same. Now, a fixed cost is a cost that will remain the same regardless of the level of activity. That is, if I'm manufacturing my desk, I'm manufacturing in a room or building that I rent for $20,000. Now, if I produce one desk, the total cost for rent is $20,000. If I produce 10 desks, the total cost for rent is $20,000. If I produce 100, $20,000. However, the per unit cost varies inversely with activity. Per unit, If my total cost is $20,000 and I produce 100 desks, well, then you see my per unit cost would be $200. If I produce 1,000 desks, it would be $20, and so on. So the cost per unit goes down as the activity goes up. That's the nature of a fixed cost. Varies inversely. So with an illustration, if I was to graph it, it would look like this. However, on a per unit basis, the more I produce, the more the per unit cost comes down. So it's talking about spreading the fixed cost over more number of units. Relevant range is a concept that relates to fixed costs. In my example, I had a building of 20,000. Now, it would have a capacity to produce, let's say, 5,000 desks. So, up to the production of 5,000, the fixed cost will not change. That's called the relevant range of activity. If I go outside that relevant range, i.e. I want to produce 6,000 desks, I have to add fixed costs. So the fixed cost will change. But in the model we're going to deduce later on, cost, volume, profit, we will always be assuming that the fixed cost will remain in, or the production will relate to a relevant range of activity. We will never go outside of that relevant range. There are some costs, though, that are both fixed and variable. For example, utility costs. Utility will go up as I produce more. But if I don't produce anything, I still have utility costs. So you see, utility cost is partly fixed and partly variable. It changes, but it doesn't change in total in direct proportion, and it's not fixed in this part. Here we have 10,000 units of production at 20,000 units. You can see the direct material was $20,000 at 10,000 units. But it's $40,000 at 20,000 units. So the activity doubled and the cost doubled. So that would be a variable cost because it changed in total in direct proportion to the level of activity. Maintenance changed as well, but it didn't change in direct proportion. It's not 16,000, it's 10. So it would be a mixed cost. It changed because of the variable portion, but it did not change proportionally because of the fixed portion. Direct labor, you can see, is variable. Indirect materials is variable. Depreciation is 4,000 at one level, 4,000 at the other, obviously fixed. Utilities is a mixed, and rent would also be fixed. So, we cannot deal with a mixed cost. We have to break it out into its variable portion and its fixed portion. And how we do that is the high-low method. That is, we take the activity at the high level minus the activity at the low level, and we look at the change in cost. Now, the change in total cost between the high level and the low level is because the variable cost per unit. The more units I'm producing, the total costs go up. An example, here we have miles driven and total costs. You take the low level here, 20,000 at 30,000. If I double the activity, the cost did not double, so it's a mixed cost. I take the high level at 50,000, total cost is 63. So the difference between 30 and 63, 33,000, is the variable portion of the total costs. And that varies in the activity. The difference in miles was 30,000. So therefore it varied at $1.10 per unit. Now that 30,000 or that 63,000 is partly variable and partly fixed. Now we know what the variable portion is. At this level, the variable portion is the miles driven times $1.10. At this level, 20,000 is the miles driven times $1.10, which would be 30,000. So therefore, I work backwards, and I subtract the variable portion from the total, and I get the fixed portion. So therefore, in this cost high-low method, we would say that the fixed cost is $8,000, but the total cost varies at $1.10 per mile. Using that, then I can predict what my total cost would be at 45,000 miles. The fixed would remain fixed. But the variable, 110 times 45,000, gives me 49.5. I have a total cost predicted of 57.5. There you have a graphic presentation of how we come up with cost behavior. Now, I want you to think of the income statement and realize that it's been prepared. This is a statement of operations. This has been prepared according to generally accepted accounting principles. But it's not very useful to us in management. We have to reformat this. And what we do is we look at all the costs in here, cost of goods sold, selling, and admin, are both fixed and variable. So we break them out. The cost of goods sold was variable 400, fixed 120. The selling, 60,000 variable, 40 fixed. The admin, 20 variable, 40 fixed. And we reformat that statement. That is, what we do is we take the sales at 800,000 and we just format the variable costs and the fixed costs. We didn't change the income statement. There's still a profit of 120. But now, you see, the variable cost varies in total in direct proportion to the level in sales. So as this goes up the same percentage. So what I can do is net these two together and just deal with the difference here, because they're going to move the same way. And that difference is we call the contribution margin. The definition is contribution margin is a sales minus variable costs. Then that contributes to cover the fixed cost. And once I cover the fixed, I now have 120,000 in profit, which is all what I had all the time. So this is called the total contribution margin. Now, I can look at it on a unit basis. I know the units sold. So the 500 is the selling price of one unit. 300 is the variable cost to produce and sell that one unit. So therefore 200 is the contribution margin that will contribute to covering the fixed costs, which is 200,000. So there's a short form of the cost volume profit income statement, and there's the contribution margin per unit. And at break even, that is the number of camcorders I have to sell such that I make 200 on each unit as contribution margin, I have to cover 200,000 in fixed cost, so I need 200,000 contribution margin. Therefore, my break even is 1,000 camcorders. If I produce one more, I produce and sell one more, then that extra 200 becomes profit. Lastly, there's the contribution margin ratio. And a ratio is always a percentage of sales or selling price. So the contribution margin per unit divided by the selling price per unit gives me the contribution margin ratio. So there are three very useful tools: total contribution margin per unit, and contribution margin ratio. And in the next model, I'll show you how we use these three in determining profit and deciding on particular courses of action.